Good afternoon and good morning. My name is Todd Rosenbluth. I'm the head of ETF and mutual fund research. Welcome to Be Cash Conscious in a Low Rate, High Tax World. We're going to talk about the appeal of active short-term bond ETFs. We'll move to the next slide so you can see who's joining me for this presentation. It's an honor to have two portfolio managers from Pimco, Jerome Schneider and David Hammer. They'll be giving their part of the presentation in more of a Q&A conversation. I'll give this myself an opportunity to invite you to start submitting questions now, and we'll get to as many of those as time permits. Let's move to the next slide. For those of you that are joining CFRA, we'll just give you a quick overview of what we're going to cover. Again, a discussion after CFRA provides research, our overview, and then of course there'll be lots of important information, risks, and an appendix for you to get to. On the next slide, you can get a better understanding of how CFRA's ETF research folds into our overall product lineup, including sector commentary, market commentary, and individual company research that helps drive our overall rating. On the next slide here is the way that we rate ETFs. We have a more forward-looking approach. We're going to talk about fixed income ETFs and what we think going forward of certain fixed income ETFs. With equity ETFs, we're using more of our fundamental and forensic analysts to help us. With fixed income ETFs, it's more a look at the interest rate sensitivity, the credit quality, the yield, as well as more forward-looking fund level characteristics. So really great insight that we're going to share with you today. And my last slide before I take things forward, if we can move forward, if we please, is a reminder that even though we're honored to have Pimco colleagues on this, we at CFRA are an independent research provider. We don't manage money. We're offering unbiased ratings and commentary for you, our clients, within the primarily wealth management space. And with that, let me move us to the next slide. Actually, let me just recap. Apologies on this. The big year we've had in fixed income ETFs, it's going to be, or has been, a record-setting year. You can see more than half of the inflows have gone to fixed income ETFs, despite it being just a quarter of the overall asset base. And on the next slide here is just to show you where the money has gone. It's been across the board, broad market and corporates. We're going to talk about municipal bond ETFs as well with David Hammer. You're seeing inflows into this space as well. So it's been a great year for fixed income ETFs. It's really exciting to have portfolio managers from Pimco be a part of this, because they really are assessing what's happening in the fixed income market and how to best do that, especially in this volatile market. So let's move to the intro slide to just show you again about what we're going to be talking about with Pimco. I'll move them to the next slide, which is just a bit of a disclaimer and disclosure and performance slide. And I'll bring the portfolio managers in on this slide here. Jerome, I'll start with you, and then we'll bring David in as well. First of all, thanks for joining us. How are you? How is Pimco looking at the world, given the increased uncertainty? What is of highest priority to you from a risk standpoint?
Yeah, first of all, thank you, Todd. Thanks, CFRA, for the opportunity to discuss our views in the light of the changes we've seen over the past few weeks and what we see going forward. It is a unique opportunity set that we're seeing before us at this point in time, but there's also unique circumstances that are going to contribute to a variety of risk profiles that we have to be mindful of. And it's one of those things that, frankly, we're going to see the utilization of fixed income probably increase despite the low rate world that we're observing right now. So, for this presentation, we entitled it Be Cash Conscious in the Low Rate World and a High Tax World. And those are two secular themes that we're going to see that are really prevailing over the intermediate future. But at Pimco, while one eye is clearly on the short-term prospects, clearly regarding fiscal policy, et cetera, we have a much longer view, a secular view, which we need to be mindful of, and is frankly useful to set the table for many of our discussions. We concluded our secular forum only a few weeks ago, and there's four main disruptors that we feel could impact risk premiums, risk asset pricings, and really preferences for risk assets over the next few years. Some of them we've seen, some of them are going to be continuations, others are going to be transformative. Climate change is definitely one of them in that regard. Technology changes are another. Simply the fact that we're going to have different types of production, productivity, that's going to be going hand in hand with changes in technology. And then the top two that you see on this slide, being China and populism, have been with us to varying degrees over the past few months, quarters, and years. And they're going to be a very profound impact, both with regard to consumerism, to consumer preferences, and quite honestly, to policy, whether that's trade policy or more domestic-oriented policies. But it's not necessarily that clear. And one thing we've seen at least over the past year, is unsuspecting things can happen. So there'll be a good number of swing factors that can really weigh on the markets, fairly quickly, as we've seen earlier this year with the changes of liquidity related to the COVID virus, and more importantly, on a go-forward basis, the swing factor is going to be news flow and actually the trajectory of not only the virus, but the ways to inoculate yourself from the virus, the vaccines, and more importantly, the efficacy of those vaccines and the timeline to put them into society, not just in the United States, but around the world. So from that perspective, there's going to be ups and downs. While we paint ourselves as more cautiously optimistic bent, with obviously growth rebounding from the depths that we've seen earlier this year, the circumstances for investors are to really create a balanced portfolio. And while the yield offered by certain aspects of what we call hard duration or treasury exposure in fixed income may not necessarily seem attractive, we actually find quite a bit of opportunities to earn carry and, more importantly, total return by having diversified portfolios, both in the taxable and tax exempt sides of the business. And so with that, these swing factors we highlight here being the virus and the vaccine, and more importantly, fiscal policy, is going to be really a profound impact for our portfolio positioning, and more importantly, the analysis of investors, whether they're institutional or retail, over the next year or so. So with that, our eye is clearly moving from what we've seen as that Fed's response function, from monetary policy being relatively easy now that we're at the zero bound of interest rate policy. And while we're unlikely to go to negative interest rates anytime soon, we look at the with an optimistic slant of the impulse from the fiscal side that we've seen earlier this year and what it means on a go-forward basis. So with that, I'll turn it over to my colleague, Dave Hammer, to highlight some of the fiscal impacts.
Thanks, Jerome. Thanks, Todd, and thanks to everyone here at CFRA. Yeah, I would add a few muni-specific risks that we're focused on. On the fiscal side, coming into this election, we advance to the next slide. One of the swing factors Jerome mentioned is fiscal policy, the size and how many potential rounds may be sustained in the future. And I'd say a positive surprise for the muni market over the next few years, one of the concerns we had was a blue wave that could lead to larger than expected fiscal stimulus combined with a large transformational infrastructure bill, which could mean a supply shock for the tax-exempt muni market in 2021. That now seems a bit less likely with a narrowly divided Senate. COVID-specific credits are very much top of mind. The muni market is thought of as state and local government credit, but there are many different types of issues that have the potential to be acutely affected if long-term habits change, specifically public transportation, senior living, bonds backed by sales taxes that are collected on brick and mortar retail. So these are all areas that I think we're a bit more cautious in ensuring that individual issues have enough liquidity if the COVID recovery takes a bit longer than expected. And then looking out a bit further over the secular horizon, unfunded pension liabilities, that's the top of mind for us in the muni market. We see many areas where investors simply aren't being rewarded or compensated for the additional risk around growing unfunded pension liabilities. It's one of the reasons that we prefer secure revenue streams that don't have to compete with pensioners on a state or local government balance sheet. And the last is demographics. Jerome mentioned climate change. We're concerned about shifting demographics due to climate. We're concerned about shifting demographics due to higher taxes and tax differentials. And frankly, there was some sign of tax fatigue in this election results with the progressive tax failing in Illinois, Prop 15 failing here in California. So while we haven't seen people moving due to taxes yet, I think as we look ahead, that is a risk.
For us to start a fixed income presentation, to start with the risk and not the reward part of it. Jerome, I'm going to move us to the next slide to then just ask you, it's natural for folks to be able to be nervous about the volatile marketplace and just move to cash or put money into money market funds. I presume you don't think that's the appropriate course of action.
Yeah, it's a balanced approach, and actually, fixed income people aren't always, a glass is half empty, type of folk. We're looking, while we're cautious, we're looking for what we would call proper risk-adjusted returns. What you see on this slide here with money market funds is exactly what proper risk-adjusted returns are not. When we think about the world and the world of risks, we've seen very much a large knee-jerk reaction to be risk-averse over the past few quarters, really with regard to corporations hoarding cash, individuals hoarding cash, high savings rates that approach 20% at the depths of the crisis. These are things that led money market funds to grow by almost $1 trillion in size over the course of the past year, only to come back down in recent months somewhat. So the key impact here is that while the Fed has done a tremendous job about placating the market through its bevy of programs, including the commercial paper funding facility that we run here at Pimco and other alphabet facilities that they run to sort of ease financial conditions, the reality is that the market has left with one severe fact, that interest rates are at zero. Fortunately, we've actually seen this in the past, from 2012 through 2015. We have at least a baseline of a playbook to work from, what has worked, what hasn't. And as a result, we need to be mindful of this. But the number one thing for investors to really keep in mind is the fact that by having this cash in money market funds, they're effectively doing two things. One, they're effectively losing to inflation, no matter how modest inflation is. So their purchasing power is effectively being eroded at the very slightest. And then there's an opportunity cost. Where could you put the cash at higher yields more opportunistically? So the one thing that money market funds do that's good is they offer you same-day liquidity. So if you have liquidity needs that are same day or over the next week, money market funds are likely the right place to be. But what we're finding is that there's an abundance of investors who have a high cash balance, high cash allocations in this low rate environment, and they can actually utilize it in a more tiered approach, a more segmented approach that we'll highlight here on the following slide.
Yeah, well, let's bring ourselves to this next slide, and I think we're going to talk about just where are the sweet spots, where is the opportunity in a low interest rate environment to go better than money markets?
Yeah, it's actually a very powerful premise and a very simple answer. Fortunately, what we need investors to do, clients of all sorts, in fact, what we do here on almost all of our portfolio constructs is actually tier our liquidity, or effectively forecast a horizon where our liquidity needs will be. And so we tier that into three groups. A tier one, which is immediate liquidity needs, which we would segment in that blue part of the chart, which is money markets. Second of all, and would be a tier two cash, so cash we need over the next few weeks or months, and a tier three cash, which is more strategic over the next few months or years even. And in doing so, by doing this, you can basically utilize the term premium and the premiums found in the marketplace to monetize them to your benefit. While you don't necessarily need same-day liquidity, you need to have a high-quality, resilient portfolio, but you can still earn income and total return along the way by moving some of that excess cash from the tier one allocations like money market funds into the tier two and tier three allocations like the ultra short strategies and ETFs that are out there. So this becomes a fairly powerful schematic for investors to utilize. And what we're finding is that that tier one allocation might only have to be 1%, maybe 2% of your total assets, but yet cash balances are often 10, 15%, or even more of your portfolio construct. So there's a good amount of proactive liquidity management that investors can utilize to segment this out to actually take advantage of these liquidity premiums. As you turn to the next slide here, what we really are finding is that there's a broader opportunity beyond the money market space, beyond cash, beyond T-bills. And this chart effectively depicts that steepness of the curve by extending beyond that money market space, showing yields to the right of that vertical line, which is the limitation of maturity for money market funds, that details the opportunity sets and the yield pickup by being beyond that money market space. While this is just simply articulating the amount of income you can pick up, we actually feel that the amount of potential for total return is actually higher given our ability to actively manage or effectively buy and sell assets opportunistically within the market. And so these broader opportunities beyond money markets affords you not only spread income and income beyond treasuries, but actually affords you a little bit more diversification than you would take. And so the key here is to have the ability to segment your cash, to tier your cash into a variety of strategies along the way. The following page does that graphical depiction of what we would actually find as the strategies which coincide with those tier 2 and tier 3 segmentations. So for the ETF landscape, we specifically devised and divided the landscape to be addressed by specific liquidity needs in those ETFs. Money market funds still serves as that modest but firm foundation for liquidity. And then moving out, we have a variety of structures which allow both taxable and tax-aware solutions, as well as our ESG solution in that short-term and ultra-short space, being our Mint ETF, which has been around for more than a decade now at this point in time, and is a $15 billion ETF in size. Our eMint ETF, which is our ESG-oriented solution for short-term tier 2 cash. Again, launched almost a year ago at this point in time, focusing on governance and environmental solutions with a focus on capital preservation and liquidity, as well as our SMMU, which is our taxable and tax-aware solution in that short-term space. But what we also find equally as attractive here, and I think it's worth noting, is that given the Fed's landscape, given the Fed's posture that they're going to be on hold for quite a while, there's actually a good amount of attractive term premium to be had by extending even slightly further out, outside that 1-year space, into what we would call the low duration space. And this is where our low duration ETF, ELDUR, LDUR, has actually come in quite a bit of interest this year, growing in size to more than 600 million in assets, offering an attractive distribution yield of just under 2%. What it aims to do is being that solution of a ballast to volatility while offering you good income and total return along the way, given the stable path that we see the Fed is going to be on for the foreseeable future at this point in time. So with this in mind, we believe that if investors can actually tier their cash, segment it into these tier 2, 3 solutions, tier 2 solutions like Mint, or tier 3 solutions like ELDUR, you can actually put this cash to work and earn some yields along that are attractive relative to the zero interest rate environment that we're in now. In addition to that, there's one thing that's really important to highlight here, and I think it's prevalent in terms of what we do here at Pimco. On the next slide, what you'll see is what we really fundamentally mean by active management. And I think this gets at the heart of what people miss, especially in the front end strategies that we manage more collectively with our peers versus the marketplace. Active management not only means buying assets that are cheap and selling assets that are rich. It doesn't necessarily only mean that you're doing credit surveillance and doing structural surveillance on different assets you might buy, as we always do, but it's also utilizing and focusing on the portfolio construction to not only embrace yield or income, but also the ability to have some potential for capital appreciation along the way. And this is the secret and the powerful driver that we saw very successful back last time that we were at the zero interest rate bound, zero interest rates back in 2012 through 2015-16, when we really saw our ability to actively trade and, more importantly, know when to actively sell appreciated assets before maturity led to attractive total returns. This is very, very different than many competitors, as they simply will often let short-term assets mature and then they simply reinvest the cash, but they thereby leave a significant amount of assets on the table. So it's a long answer to your question, Todd, but the final slide sort of worth highlighting is sort of the landscape and the risk-adjusted returns. I started this conversation by stating that when you get through and think about the landscape, the glass is not necessarily about being half empty. It's about producing returns which are positive and have positive risk-adjusted returns. And that's really ultimately what our strategies aim to do, is provide return with as little volatility as possible. So when you look at Mint and ELDUR and you look at the volatility composure of them being 1 to 2% annualized volatility, you can see that return per unit volatility is actually pretty impressive considering the returns over the past 3 to 5 years. And so from a larger perspective, these type of fixed income strategies generally are viewed as a ballast to overall portfolio volatility, overall market volatility, while still safeguarding capital and trying to be and immunizing them from defaults or impairments along the way. But the key to the starting point, just to come full circle, is making sure you can actually tier your cash and utilize that tiered structure to take advantage of the opportunity sets we see at the front end of the taxable and tax-exempt curves.
Thanks, Jerome. Thorough answer is always helpful for our clients. I want to turn this to David. We'll move to the next slide here as I ask you the question. We've got the election behind us. There was a prospect of additional fiscal spending. How do you view the prospect of rising volatility and the potential for rising tax rates ahead? How should taxable-oriented investors think about that?
I think as a result of the election outcome, some investors may observe that higher taxes now look less likely than maybe they had anticipated. But I'd highlight for munis they're already quite tax efficient and attractive without a change to tax rates, particularly versus treasuries, which are near all-time lows, and also other credit markets. The muni market has been a bit slower to recover. Many of the opportunities that Jerome mentioned due to a steep curve are even more pronounced in the tax-exempt muni market. The Fed was involved, continues to be involved in the very, very front end. All of their facilities are inside of 36 months, but the average muni maturity is 12 years. So it's led to a much steeper curve and additional pickup after taxes. The chart here in front of you on the right-hand side shows muni credit spreads. And the lag here has been a result of U.S. retail investors that have been slower to come back to credit markets more broadly than institutional investors. We've seen large inflows into investment-grade corporate credit, high-yield corporate credit. The flows into the muni asset class have been much more muted. High-yield munis are actually outflows for the year, and the result is credit spreads that have just not recovered as quickly. So looking at BBB rated spreads in the 1 to 2 year portion of the curve, tax-exempt munis, pre-taxes, are trading at higher yields today than corporate bonds. So the after-tax pickup can be as much as 100 to 125 basis points. That's a lot of after-tax income earned for U.S. taxable investors. Flipping to the next page, I mentioned BBB munis in the excess pickup. Default rates on munis are also quite low historically versus other credit instruments. So you'll see on the right here, whether it's BBB munis or single A rated munis, default rates have remained a fraction of corporate bonds. One question we've received from investors quite a bit is, will this hold going forward? We've spent a lot of time here at Pimco since March stress testing individual bonds for a slower economic recovery. And we think the answer to the question, will muni default rates remain low? We think the answer is yes. We see this as more of a downgrade cycle than a default cycle. And why is that? Many high quality muni issuers are backed by non-cyclical revenue streams, utilities such as water and sewer, public power, very large hospital systems. State and locals, unlike the federal government, have to live with balanced budget requirements. So if their tax collections come in lower than expected, as opposed to bonding out, they will cut expenses. Now that has an impact on growth, but as a muni bondholder, that's quite reassuring. Housing has been a bit more supported. Local muni credit fared particularly poorly after the great financial crisis, but with house prices stable to increasing, property taxes have remained very resilient. So we think that's an important takeaway for local credit. And then just lastly, we have seen unprecedented support from the federal government with the first round of CARES and the potential for more as we move past the election. Now, that's not to say that there are not pockets of the market that we're concerned about. Senior living, more speculative grade transportation. These are really idiosyncratic components of the high yield muni market, but we think for investment grade muni credit, it remains a very high quality asset class. Beyond credit quality, one additional property that we've observed for investors in a greater portfolio context is lower correlations to risky asset classes. So flipping to the next page on slide 13, this illustrates historical correlations between SMMU, which is about a 2 year muni duration historically versus the S&P 500. And what we've observed over long periods of time is munis have a lower correlation to the equity market than other credit products. So that means more resilience, smaller drawdowns in the event of an equity sell-off. And then moving to the next page, putting this all together on page 14, I think the most important takeaway here is if you're a U.S. taxpayer, what you have experienced in the muni market has been greater after-tax return with lower volatility versus other investable options. We think that holds true. And furthermore, the cross currents in today's muni market mean that the analysis is more complex than it used to be. Perhaps there are 50,000 different issuers to choose from. So for active managers that are looking at not just income, but also total return, this is a very target-rich environment where we see opportunities to pursue mispriced securities that are both too rich, or maybe credit stress isn't priced in, or in many cases, there's a bit more fear in the market and in the price than there should be.
Thanks for that, David. I'll move us to the next slide and just pick up on something, Jerome, you touched on earlier about ESG. We actually wrote about ESG and the growing number of ESG products and the importance of looking inside these products. Can you just talk about how Pimco is using ESG to support the portfolios and why?
Yeah, quite honestly, Pimco has been involved in ESG and sort of environmental and consciously aware portfolios since the early 1990s. So it's nothing new to us, even though it's picking up steam in terms of vocation and sort of discussion points for many of our clients. We've obviously had solutions and been constructing solutions on this forefront for quite some time, with really the main idea that as investors we can influence the changes that need to take place in this world from the ESG format. We launched our focal point of ESG being EMINT, EMNT, which is the step brother, effectively, of our Mint platform, a little less than a year ago, to great interest. It has done quite well over the past year in terms of performance and growth as expected, and we expect over the medium term that this will be a growing area of interest to investors who want to have a larger footprint and impact on maintaining awareness of issuers and more importantly, of the importance of ESG premises and tenants. One of the main impacts that we can have is directly dialoguing with issuers. So our credit analysts, our portfolio management teams, et cetera, are directly working with issuers, not only to issue green bonds, but to be more environmentally conscious, to have better governance policies, to be more environmentally aware. Clearly, one of those ways that we can do that is looking at the carbon footprints that many of our issuers participate in and contribute to. And so what we can see on this slide right here is simply the improvements that we can make from an investment point of view, which is pretty drastic versus the benchmarks that we see, meaning our EMINT product can show a drastic improvement in investments by targeting those issuers who have a lower carbon emission output and intensity level than you find typically in a Barclays 1 to 3 year index. So active management once again can prevail in creating powerful impacts for our clients, and we view this as being a long-term not only discussion point but a long-term powerful impact that Pimco can help lead on behalf of our clients going forward. So we're excited about this and excited about the evolution of the sector.
Thanks, Jerome. I'm going to move us rather quickly. We can move to the next slide, and I'll put this up here, and then we'll go through the disclosures as well as we start to take questions. But I'll put this up there, and as you start to answer this first question, we can maybe make our way through the disclosures. But this slide talks about what to watch for in 2021. Obviously, we've had the election. We have some news about a potential vaccine coming in the near term. What are the highest priority things for you to focus on in 2021? I'll put that to either of you.
I think credit risk is clearly a dominant theme. It's been something on the top of our mind since late 2018, where we've tried to avoid the beta of credit risk. I think that's one avenue. I think the trajectory of the vaccine is something that people, while optimistic given the news over the past 24 plus hours, is something that we have to be rational about and patient about, and could have impacts on the rebounding growth that we've seen over the past 2 or 3 months, which has been astounding, but yet a lot of room to go. Remember, job creation that we've seen since the lows has only rebounded less than 60% and recovered about 60% of the jobs that we began the year with. So we have a long way to go in this. So that combined with what David was mentioning, which is really the fiscal element of the solution, that's going to be a challenge that we're going to have to sort of iterate through. Whether fiscal policy, if it comes sooner, that's obviously a great thing. But more importantly, the size, and if it's accompanied by infrastructure policy, these are things that contribute to the bottom line, meaning contribute to spending patterns of consumers, contribute to growth, and then ultimately contribute to the inflation rate, which isn't necessarily a bad thing because higher inflation means that market activity is picking up, and more importantly, it puts us closer to the target inflation rate that the Fed needs to achieve and beyond, which is unlikely to happen before 2023 at this point in time.
Thanks. As we'll move to the next couple of slides, which will get us started on the disclosures and the appendix. David, anything you want to add to that as to what you're watching for in 2021?
Yeah, I think Jerome covered all the big issues. The one that I would add that's muni market specific is the return of tax-exempt advance refundings. That was a change in tax law in 2017, which has driven a lot of traditional tax-exempt supply into the taxable muni market, which has grown substantially over the last year. A narrowly divided Senate, in our view, makes it less likely that tax-exempt advance refundings come back. That, coupled with valuations that have lagged the recovery, should provide a positive technical for the tax-exempt muni market.
Okay, thanks. So this visual is a reminder. Thanks for people who have submitted questions. I'm going to turn to my colleagues in a moment to do that, but please submit questions. We'll get to whatever we can. David, I'll put this to you. Jerome touched on his view about active management relative to what's been happening within the comparable indices. What is, I guess maybe you could just add to the value of active management in the ultra short municipal bond market space. What value add are you guys providing?
Yeah, I'd say bottom up, the muni market with 50,000 different issuers is really the ultimate credit pickers market. We use our extensive resources here at Pimco well beyond just state and local government analysts to really understand what might drive a revenue stream that backs municipal bond. A few examples, property taxes, we see bonds backed by housing. Bonds that are backed by sales taxes, we oftentimes drill down to the individual contribution, which can be commercial retail or brick and mortar assets. So using non-traditional muni credit resources oftentimes can lead us to different conclusions. And then on the structural component, looking at low yields in the very front end of the curve with tax-exempt muni yields yielding 25 or 30 basis points, the steepness of the curve and harvesting that roll down and carry becomes even more important. Owning a bond that may have a yield that's only 10 or 15 basis points higher, once you add in the appreciation of that bond rolling down the curve a year, you can at times double the effective total return over a 1 year holding period. So those are the two areas that we think offer a lot of opportunities to generate alpha in an active portfolio versus a passive one.
Thanks. Jerome, I'll give you the last word on this to just reiterate again the benefits of active management again between the tiering of what you do with Elder and Mint.
Yeah, we started this presentation by highlighting the fact that the opportunity set at the zero yield and zero benchmark rates is unique, and it is, and it requires varying degrees of freedom and the ability to use your resources to find assets and asset classes and issuers which are unique in this environment while being defensive and steering away from the typical or the beta or the index, which might present unforeseen risks. That's exactly what all these strategies have alike, whether they're taxable or tax exempt. So strategies like eMint or Mint or Elder or any of the tax exempt as well, they're going to embrace these constructs of active management with resilient resources to help manage the process. We don't view this as a smooth road, but we do view it as an opportunity for managing risk-adjusted returns, and more importantly, trying to find good sources of balanced income, balanced total return, given the uncertainties which might still prevail over the next few years. So we are being, in fact, cautiously optimistic on those opportunities. We're looking for those opportunities, we're identifying them, but yet we don't feel the need necessarily to reach for a ton of risk right now, given the changing landscape both David and myself see for the immediate future.
And so thanks for that, guys. I'll move us forward and just to say, move us to the next slide if we can, please, to just thank everybody for joining and to tell everybody about the next webinar. Let's go back one slide if we can. Apologies on that. The next webinar that we at CFRA are having next week about our holiday outlook. Hopefully you'll tune in for that and get a closer look at our MarketScope Advisor platform. With that, I'll show this slide with my picture and my colleagues' pictures to say thank you all for joining. Appreciate your feedback and thank you all for participating in this CFRA webinar. Have a great rest of your day and a great rest of your week.